Hello, this is Brian Resney, President of Resney Wealth Management, bringing you an important update about the economy and the investment markets. Well, we're clearly into the first quarter of 2024. A number of factors have come out. GDP has actually been pretty strong. If we take a look at the employment numbers, actually very strong. I've had some clients ask a question in regards to if we see on our research a slowing job market, then how are the job numbers so strong? I'll talk a little bit about that. One of the things you have to realize is it's not how many jobs are created or how many people are taking new jobs. It's really hours worked. So the hours worked are actually back to pre-COVID levels of 2020. So if you really take a look at hours worked, even though we added a lot of jobs, let's say 350,000 from the payroll numbers from last week, hours worked are less overall. So if you extrapolate that out over an annualized basis, based upon less hours worked but more people working or getting jobs, we actually would have created somewhere around 33,000 jobs on an annualized basis each month versus the real number that says maybe it's 195,000. So at the end of the day, if you have twice as many people work, but everybody's working half the hours, you're not working more hours. So people are not making necessarily more money, or there's not double the income to, let's say, pay for GDP product type growth. So ultimately, the job numbers look good, but we're working slightly less hours, so more people are working, but you're not necessarily getting ahead on the growth of the U.S. economy in a meaningful way. So the market's not falling apart on the job side, but it clearly is slowly deteriorating a little bit, which is helping on the inflation front. So all the numbers we're seeing on inflation are coming in check, and that's why I've said repeatedly, I firmly expect the Fed to reduce rates this year. It depends how slow the economy really gets. It depends how fast they decide to act, and that's really going to depend where the economy heads for the whole entire 2024. I think this year will be decent though on the GDP, and I think we still will run in the 2 to 2.5% range full year on GDP. Assuming we don't have any crazy events that happen from left field. But that kind of growth, given the current valuation of different areas of the equity market, I think we potentially could have a pretty decent year in the equity market. Certainly not as good as last year, but then you never know. But in the meantime, remember, we could have a 10 or 12% pullback in the equity markets and bond market before we go up another 5 or 10%. So volatility is normal, and that's why I always try to educate our clients. Don't expect every year you're up 10 or 15%. You're going to have a year you're down 10 or 15% before maybe the next 3 or 4 years are very good and maybe you make 50% over that time frame. Every year is a little bit different. We do a lot of research to see where the economy is headed, and it's headed in the right direction. So don't get me wrong. We're not looking for a bad year, but you need to expect that every year is not going to be up 15 or 25%. It's just not realistic. Out of a 5-year rolling time frame, you're going to have one so-so year or down year. You'll probably have 1 or 2 decent years and probably 1 or 2 really good years. And that kind of gives you that overall 5-year average. One of the things that I stress to our clients is don't spend more money just because you had a really good year. And this often happens. I will have a client that says, hey, I need $8,000 a month to live the way we want to live. And all of a sudden their portfolio does substantially better a year or two than we anticipate, and they see their $1 million go up to, let's say, 1.4 million. That's for the future when we have bad years, by the way, folks. But what will happen is they'll run out and buy a truck and a camper and create some extra debt and or just spend that money. And of course, their $8,000 monthly budget just ballooned double that year because they went on to spend a lot of extra money thinking that every year is going to be like that. So the reason we do retirement projections for clients and the reason we really want to keep you in check is because if you're 65 or 70, you could have another 20, 25 plus years between both of you that you're going to live and that money needs to be there. So assume your account did much better last year than anticipated. Don't think you could spend a lot of extra money because next year you might be down 10%, which kind of brings you back to that overall average on that 5-year that we kind of look for. While our clients we feel have done better than we anticipated, we don't want you to spend money that is always going to continue. It's better to be a little bit more cautious and conservative than overspend. Again, economy is doing well. GDP looks favorable for this year. The employment situation looks fairly stable, slowly deteriorating a little bit, but that is actually somewhat needed in order to bring that inflation number down, which we're ultimately seeing. There's a lot of geopolitical events in the world, as everybody talks about. We've always had geopolitical events. These are these left field things where something could happen and it drives the market down 10% overnight. Those are realistic scenarios when you're trying to grow your money over the next 1, 3, 5, 10, 15 years. Remember, whether you're 40, whether you're 95, you're a long-term investor as long as you're not going to spend all of your money in the next 3 years or less, which would be none of our clients. You're going to spend pieces of it. So let that money grow. Try not to be emotional and realize volatility is your friend and ultimately will help create more wealth down the road. If you're a client, of course, and you have any questions about your portfolio, please give the office a call. If we need to schedule a review, either in office or phone, we always want to make sure our clients are well taken care of. Have a safe and profitable day.